Afternoon, everybody. Greetings from a slowly reawakening New York City. My name is Paul Birkett. I do these 10-minute updates every week for the general market, I guess, people who buy loans from us, sell loans to us, and who are often financing partners. Some people had asked if I would do a longer session and invite all of our investors. So there's three groups of people on the call today. There are a small number of our investors, I guess a small number of prospective investors, and then other folks who join every Thursday at about 7 p.m. For my 10-minute market updates. So it's 1 o'clock here in New York. So good afternoon to anyone who's on the East Coast, and good morning to those of you who are on the West Coast. And I see some Euros here with us as well. So to my European guests, thank you for joining. I'll do some comments for 15 or 20 minutes. I have some prepared slides, and then I'll take questions and answers if people have questions and answers. So what I'll do is I'll leave you on mute until the end, and then if you have any questions, you can either chat them, so you can type them into the Zoom chat box, or just wait to the end and we'll unmute everybody and people can just ask questions of me directly. I'm joined today by Albert Loiseau, who joined us about 3 months ago now from American Express after 18 years there. He helps manage risk, and he also helps me with a lot of the marketing activities that the fund does, and some of the middle office kind of activities to make sure that everything runs smoothly. So I'll share my screen and I'll move on to my prepared remarks. And I hope you can see this slide. I think that's the slide that you can all see. Yeah. So I'll talk a little bit about what's good, what's bad, and what we think is happening next. To butcher the old phrase, I don't like to make predictions, especially not about the future. And so we'll just review the data. There's a bull case and a bear case, as there is for everything. And I'll talk a little bit about what we're doing. And I think it's probably best summarized as being on the conservative side of careful, and just seeing how things play out, because I'll talk to you a bit about the characteristics of the market and why we're being so careful. So I don't know why this page won't advance. There we go. So this isn't a sales pitch, but unfortunately, since we're an SEC regulated fund, I need to talk to you a little bit about some of the disclaimers. This is not a solicitation. We're not attempting to raise funds. And although we've had success in the past is no guarantee to the future. Those of you who are already investors, thank you. Those of you who are prospective investors, please do make sure to read the entire SEC filing and ensure that you've reviewed especially the part that deals with risk. There are no safe investments. Even holding cash, you're at risk of inflation. So please make sure that you understand what you're doing when you're investing in a fund like ours or any other fund. So just quickly about what it is that we do. We're a non-performing loan fund, although we've been buying performing loans too. And the key objective of the fund is to pay a 8% preferred return to our investors. So we make distributions every month. We've never missed a distribution. We've never missed a capital return of capital. In fact, we haven't lost any money on any of the money that we've invested since we began the business in 2014. But that's no guide to the future. The future could be very different. And the fund has three key features. The first one is an 8% preferred return. The second one is monthly dividends. So some investors, particularly people considering retirement, choose to collect their dividend every month. So we either mail them a check or wire them funds every month. Some of them choose instead to reinvest those funds and compound their returns. And we also provide best efforts liquidity. So while the fund has got another 3 years to run on this current version, if someone wants to leave early, and we've had one investor leave early, they can send us notice that they want to redeem, and we will repurchase their shares from them, assuming the company has money to do so. How do we generate money? Well, we buy non-performing mortgages, and we work with the borrowers to get them reperforming. So this is a particularly interesting time for this industry, because what was at the peak 10% of people not paying their mortgage in 2008 is now already just about at 10% again. And we've got several weeks to go where we think that there will be a further spike in people not paying their mortgage. Our prior funds have generated about 21.5%, or if you want to look at it in IRR terms, 17.5%. And that is no guide to the future. But fundamentally, what we're doing is we're taking a house like this where the borrower isn't paying. And typically what we're doing is buying the mortgage, not the house, but the mortgage on the house for about 60 cents on the dollar. And the way the workout happens is you buy the mortgage, for 60.
Outside of that system, we should be able to rely upon the SOC2 provided by Black Knight. So that's what it's about today.
Sorry, Albert, can I ask?
I think people on this point, I think we would be wasting money.
Yeah, sorry, it was just one new participant.
Thank you.
And Paul, I think you want to reshare your slides.
Yeah. Is it not share? Can you not see what I see? No.
We're not seeing the slides.
Oh. How do I do this? Share screen.
Yep, there you go. You're good. Okay,
great. Thanks for pointing that out. That would have been particularly tedious for you to listen to me talking blah, 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 and not looking at my lovely slides. So we're buying the houses, the mortgage on the house at about 40% off. So if the house is worth 100,000, we're buying the mortgage for 60,000. And then the name of the game is working with the borrower to get them back on track. Now, the reason they've stopped paying is usually because they've lost their job, or there's been some life event has occurred, which means they fall behind. And the way a mortgage works is if you stop paying, the bank starts to accrue late fees and missed payments on that mortgage. And most people struggle to catch up. So if you miss 10 payments of $1,000 each because you've lost your job, and a year later you get a new job, the bank expects you to make 10 times $1,000 payments. And since you don't have any money because you've been unemployed for 10 months, you can't make the payment. And that loan then finds its way into foreclosure, and eventually the house is lost to foreclosure, the house gets sold, the bank gets repaid, and the borrower loses whatever equity they had in the home, in many cases, and may even be homeless. Our business is we solicit banks on a daily basis looking for loans where the borrower is not paying. We then buy that loan at about 60 cents on the dollar and work with the borrower to get them back on track. So it's quite easy to explain, but it's much more complicated in reality because it's a highly complex legal process to get the borrower back to performing status. And then we need to modify their loan, change their terms, because otherwise it won't amortize as it should because they've missed payments for 10 months. And many times we're buying loans where the borrower has missed payments for 30 or 40 or even 50 months. So we do all of the accounting and legal work, get them back on track, get the loan performing again, and use the monthly payments that the borrower makes to make payments to our investors. And we've done that. We've done that using a technology system which we call Symphony, which has built out the entire workout process. I won't go into any detail on that because unless you're a data nerd like me, it's probably not the most interesting thing to hear about. But if you have questions at the end, we're happy to take questions about that. Our past funds have done very well. We've made an IRR of about 17.5%, but that's no guide to the future. We can talk about this again and again. All these details are in the SEC filing. But let's talk a bit about the news. So the good news, it's incredible that the entire country just about has been affected by this terrible virus. And I've just pulled this chart, as I do every week, from Johns Hopkins. And this shows by county, the darker the color, the more people have fallen ill. And you can see up where we are in New York, up as far as Boston, there's been a big kind of area where there's been an awful lot of sickness. And indeed, today, I just listened to Cuomo's press conference, the first day since this whole thing began, where deaths fell below 200 for the day, and that was yesterday. Truly horrendous. But the economy is slowly getting back to normal. We saw maps yesterday throughout the whole Midwest, many economies reopening. We deal with a bank in Phoenix, and they're now back almost to normal again, which is good news. They were also a hotspot. And I just pulled this graph, which shows across all of the markets, these are the curves, and you can see the US is at the top, declining. And I think the spikiness is more to do with data collection than giant ramps up and down. The only market that seems to be showing continued trouble is Brazil. Every other one of the markets, and I guess looking on your screen that the font might be small, but France, Spain, all across Europe, even Iran, which had very bad cases in the beginning, are in decline. So while we're not out of the woods at least seem to be getting thinner and not thicker and deeper. And just before this whole thing began, this is what the market looked like. So we had seen since 2012, when the real estate market bottomed, up until the end of 2019, which is when the latest data is available, a big boom in house price inflation. So that was building equity into just about every homeowner, and almost no default rates. There was a bit of a spike in 2018, but that had fallen back down. And then on the right side of this chart, you'll see a question mark, because I already know that we're back up at 5 or 6% into default. The FHFA, which is the regulator that governs Fannie and Freddie and Ginnie, which is about 60% of the market, has very generous forbearance terms with their borrowers. So you can miss mortgage payments for any reason right now. And you can miss up to 4 payments and have those payments put on the end of your loan with no penalty to you or to your interest rate, or to anything to do with your loan. It's a free hall pass for 4 months. And that's going to be a lifeline, I think, for a lot of people, particularly for those at the bottom of the wealth pyramid, those who are barely scraping by on a monthly basis. The question is, what happens after those 4 months go by? A lot of the loans that we own and a lot of the homes that we focus on have done very well over the past few years. We buy low price, low value. Typical home value is under $200,000, which across the US is the bottom 25% of all homes. So long as the home is occupied and in reasonable repair, it's a home that we will look at. And I think there's a floor under those assets. It's very hard to build a new home for less than $100,000. And many of the homes we're buying are just right around that. So I think there's a limited downside for the value band that we focus on. I have a very different point of view in high price markets and particularly second homes, but I'll talk about those in just a few minutes. If you break it down, this is just data from CoreLogic, and it breaks down of all the homes across the entire country, is about 60 million mortgages in the US, which have equity and how much of them have equity. And if you look across the legend to the bottom, 50 to 54, 55 to 59, these are all of the folks that have got significant amounts of equity. And above those, there's obviously, this chart doesn't cover them, but there's also a lot of homes with no mortgage, people who've got very small amounts of debt left on homes. But about 64% have at least 10% equity in their home. The area of worry is on the right-hand side, from 95 up to 125%. These are folks who either bought very recently with Ginnie Mae, typically loans, where they'll accept a borrower with a FICO credit score of less than 600, which puts you in the bottom third of FICO scores. They'll let you make a down payment of about 3%. There's some other special programs which will allow you to buy even for less, even 2.5%. And these loans are all government insured. So if the borrower stops paying, the government backstops all of this paper under the current legislation. And I think this is the area where we will see probably, if we see defaults, this is the area where we're likely to see defaults that are not going to be picked up by the government. So what's the bad news? Well, the bad news is it's really the debt market, not the equity market, that sets the tone. And I think that there's been the analogy of kicking the can further down the road. And I think we're certainly seeing that right now. So we see TV every day, all day, about the equity market, and that's about a $25 trillion market, although it's probably about 23 right now. The debt market is 45 trillion and growing. And so we're hearing the Fed and Treasury producing more and more stimulus, another 3 trillion to keep the economy on life support. And I think that's the right thing to do. Powell has said there's nothing we won't do, unlimited liquidity, unlimited bond buying. And indeed, they announced another program today that they're buying ETF junk bonds, which basically is indiscriminately buying any and all debt of US corporations. So everything that can be done is being done to avoid any kind of a recession, for any further, anything that prolongs the current recession that we're in right now. The issue with all of the debt is, and this chart goes back to 1995, but it basically combines private consumption and nominal consumption to give an annualized growth rate. And what we're finding is, as debt increases and increases, excuse me, as debt continues to increase, the peaks are getting lower and lower. In fact, each time about down as much as 30% below their peaks. And this is data from a subscription service that just purely grinds the numbers for us. And it looks like nominal GDP is growing, or is falling, I should say, while debt is growing. So every dollar of debt is producing less and less further growth. And I think we're going to see a very big decline, much further than the 3.1 that we're showing here, when all of this stimulus is said and done. I follow Jeff Gunlock. He runs Double Line. They're probably the most successful and almost one of the most vocal debt investors, so bond investors in the US. And he's taking a very negative view in two regards. The first is just saying 3 trillion of borrowing. I think that's just for the quarter. We'll see much more than 3 trillion. We might see 3 trillion followed by a second 3 trillion. And secondly, the bill rates, the interest rates falling to low single digits. The 10 years at 60 basis points. It's actually, I'm looking here, it's at 70 basis points, but still under 1%. We're trending towards zero. And whether or not the Treasury wants us to get to zero, I think the market is forcing us, at least in the short term, towards zero. So is that a good thing or a bad thing? Well, it could be a very good thing for debt investors. So what this chart shows is the 30-year fixed rate mortgage from 1998 right up until just about now, and the 10-year Treasury yield. And I told you the 10-year was down at 60, 70 basis points. Over time, those two, so what's happening with the 10-year and what's happening in the mortgage market, move in lockstep. So one thing is for sure, at least over time, we will see a fall in the 30-year mortgage. I think it's just over 3%, about 3.2 or 3.3 right now. That could easily get into the twos in the next couple of years, or certainly in the next couple of quarters. And low interest rates are very good for housing. The problem is, the counterfactual on that is, again, this is data from CoreLogic. There are a lot of homes in the US that are, by CoreLogic's reckoning, overvalued. So roughly a third of houses are undervalued, roughly a third are overvalued, and roughly a third are about right. And that's driven, they do the math based on average income and average debt load in each zip code across the entire country. So look at where the red is. You're finding places that are heavily dependent on second homes, a lot of coastal property, a lot of high price markets in the Northeast, places like New York, places like Miami, Florida, anywhere across the Gulf Coast, and the oil markets. So the oil markets have a double whammy. Oil, whatever it is today, $30, $20 a barrel, which is about at the cost of production. And also those markets where there's been a heavy reliance on oil, but just oil and nothing else. So those oil patch type markets, big problem. And then heading as you go out west, a little bit more trouble in high price Californian markets, up in Seattle, places like that, but also the leisure markets, Nevada in particular. So yes, low interest rates help housing. Will they help offset overvalued markets? Difficult to tell. And refinancings are red hot. So there's no new homes being sold. It's very hard to go and look at an open house right now since most of the country is shut down. That said, we've seen a big uptick in our book, in our performing loan book. So these are loans that we've owned for a year or more that have been performing. We're starting to see refinancings. And the refinancings are happening because people are seeing that they're paying 5 or 6%. Our average rate is about 6% on our loans. And you can get a new mortgage for 3.5%. Well, in just rough numbers, that will reduce your payment by about 45%. So if you are one of those borrowers I showed on the earlier chart with a lot of equity in your home, you can refinance, assuming you have the good credit. You can refinance that mortgage and reduce your payment by 50%. So several $1,000s in many people's cases over a year of that could go into retirement savings, or it could even come into AF, into one of our funds. But refinancings are very hot. In the short term, there's very little happening. So this is the spread between the mortgage rates and the 10-year. And what I showed before, when it was a longer time frame, was that they were both heading down in lockstep. But what's happening most recently, and I just pulled this data from Bloomberg, is if you look to the very far right of the screen, you would expect that rates would be going down. But what's happened is, because of the enormous disruption to the market, most lenders lend from a warehouse line, which means they've gone to a big bank, one of the big 5 banks, and they have a facility of several $1 billion. And every day they write a new mortgage, they put that mortgage on their warehouse line at the bank. And at the end of the month, once all the paperwork is done, they sell those loans to Fannie, Freddie, or Ginnie, or to a private investor. And that just has not been happening recently because of all the disruption in the marketplace. And so to slow demand, originators have been increasing rates. So even though their cost of funds may have declined, they're increasing rates because they have no liquidity. They have no actual cash to make those loans. But I think that will resolve in the next quarter, next 2 quarters, and you'll see rates probably below 3% on a consistent basis, maybe even as low as 2% for a 30-year mortgage, which would be, I don't remember when it was ever that cheap before. I'm sure maybe it was, but it was many, many years ago. So what do we think is going to happen next in terms of the overall market? I use this every time, which is, we saw, these are the housing prices way back to 96, and we had a big bubble. And then for a period of time, there was a calm. And if you remember the crash and the recession of 2007-8, between 2008 and 2012, real estate prices continued to fall. Prices of homes don't move that quickly. It takes a while for price discovery to happen. And then from 2012, prices grew 60% to where we are here in 2020. And the question is, do we see a fall like we saw in 2006, 7, 8, 9? Or does it kind of continue along with flat prices because of the super low interest rates, an enormous stimulus from the Fed, which they've done in 30 days what it took them 60 months to do the last time? So it's a very different, while the trend is the same, the velocity is very different. So it's not clear which one of those things are going to play out. And the concern for us is, well, what do we do given the uncertainty and given what we're seeing? So we're staying away from anywhere that is obviously very high risk. So that means second homes. We've seen a lot of assets coming for sale, in particularly in Miami. I don't mean to pick on Miami, but there's been a lot of things happening there. Miami is often referred to as the capital of Latin America, because if you spend any time there, you hear as much Spanish spoken as English. A lot of Argentinian money is there. A lot of Brazilian money is there. Well, they're 2 economies that are in deep, deep trouble right now. And they're buying all of those luxury condos you see in the top right-hand picture on Collins Avenue facing the beach. Those people are no longer there. In the Northeast, we're seeing a lot of distress in every strata, in single-family homes, in condos, apartments, even in construction. There's been no construction for 2 months. And I hear it starting just this morning as I came to work. You could hear some construction, but there's really been very little. And the financing on skyscrapers is a highly leveraged, for the average developer, is a very highly leveraged endeavor. They'll typically have mezzanine finance for about a third of their construction costs, with interest rates above 10%. So if you're not building for 2 months, the debt eats you. So all of those deals, not all of them, but a very large majority of those deals are being renegotiated right now. And that's an environment where sales prices, at least sales discovery, is hard to find. There are not too many condos being sold, certainly not in the Northeast or in Manhattan. And then moving to the oil economies, the tar sands in Texas, we saw on earlier chart, red across a lot of Texas. They've had a boom for years, and I think that boom has come to an end with low oil prices. And low oil is just bad for Texas. There's no other way to say it. And then in the leisure markets, I read recently the governor of Nevada saying it's time to reopen. I mean, I really wonder, are people going to be rushing back to casinos anytime soon? I just don't see it. So there are 4 markets that we're staying away from. There's no saying in the bond market, there's no such thing as a bad bond, just a bad price. And I guess if prices are low enough, when we get back to the prices we saw in 2010-11, we may start buying in these markets again. So what are we doing as a business? What's actually happening as a business? We were lucky. I'd love to say it was my great skill and the team's great skill, but we closed a lot of funds out just at the end of 2019, and we had a lot of cash. We'd been bidding on portfolios and not getting them because someone else was bidding 4, 5, 6 points ahead of us. So we might bid 60 or 61, and the loan sold at 64 or 65. And I'm just not comfortable getting in at those kind of rates. But we're sitting on the cash and paying our investors out of our own corporate reserves, because the options are give the money back, which you can always do. But I think there's going to be lower prices ahead. So we're keeping the cash and paying our investors from our own reserves. We're continuing to bid, and we're bidding at about 25% less than what we would have bid in January. So we buy lower value first liens and we buy second liens. And we think they give us good optionality on the future, in that if the market stays the same, well, we'll do very well. If the market falls, we can sustain a fall of 10 or 20% without any immediately obvious problem to keeping the show on the road. And if markets fall more than 20%, then I think we've bigger problems than how our funds perform. That's really an end of the world type scenario. We suspect there'll be lower prices ahead. And even if there aren't, we will just continue to very carefully, rather than try and win big trades, we're trying to chase smaller deals. And we've started doing some third-party work for other people, providing services to others. And working the deals more slowly to maximize the returns. And I think it's best summarized for waiting for the other guy to blink, because the sellers, when we speak to them, they're saying, well, there's no reason for prices to be any lower than they were in February. And I think that that's just an unrealistic review of the marketplace. I think there's a very big reason for prices to be lower than they were in February. And I think about 25% lower is the right price. And that bid-ask spread will narrow over time, I think, over the next quarter or 2 quarters, because remember, this market doesn't move fast. Unless a bank goes bankrupt, and there's really no prospect of that, there aren't going to be fire sales. I think there'll be a slow grind lower in prices as price discovery happens and these loans start to sell. There are going to be a lot of loans. Currently, about 6 million loans are in forbearance. I don't expect all of the people, currently 33 million people who are unemployed, I don't expect them to have a V-shaped recovery and snap back to where they were before in February and get back to work and everything is back to what it was before. I think this will be a long U-shaped recovery, and we'll still hopefully not be talking about the sickness in terms of people falling ill and hopefully not dying, but falling ill. But we'll still be battling the economic outcome, I think, for the next several quarters, well into 2021. And that mortgage will, the implications on the mortgage industry will grind out over that period. So that's the end of my prepared remarks. If you have any questions, I'll stop sharing my screen and I'll ask Albert if you could help me out and allow people to ask questions if they have any questions.
Thanks, Paul. If you want to type in your questions in the chat module, we can respond it from there, or let us know if you want to speak, and I will go ahead and unmute your microphones.
So Wayne has asked, did I say that we're buying second liens? Wayne, we are buying second liens, and we're taking a barbell approach to our second lien purchases. So a second lien is a loan which is often taken out at the same time as a first lien, and used to avoid having to pay private mortgage insurance. And it's done less nowadays. At the peak of 2006, there were about $4 billion of unpaid principal balance in second liens. It's now about $1.3 billion. So it's a much smaller business. We think there's good value in second liens where the borrower has a very high FICO and there's a lot of equity in the loan. So you can buy the loan for a much lower price compared to a first lien, and we think they have similar risk and reward characteristics. We've liquidated about 1,000, maybe 1,500 second liens since we started in 2014. It's a highly specialist business because if you do it wrong, you can lose a lot of money very quickly in second liens. But we do have resident expertise in that area. In fact, that's the area that I began in. The first 700 or 800 loans we owned were all second liens. So yes, we do buy second liens. And we think that while there aren't that many available right now, we're actively looking to increase our exposure in the second lien space. So a question is, who is our servicer? So we work with 3 different servicers. We do not service loans ourselves. So to those who are not uninitiated in the service in the mortgage business, when a bank makes a loan, they either sell or assign the rights to collect the monthly payments to a third party, and that third party is basically a room full of accountants who collect the payment from the borrower, process the payment, distribute the capital and interest, principal and interest, to the bondholders, send the borrower their monthly statement, and send them their tax details at the end of the year for them to do their tax returns. So we are not a servicer, but we work with licensed servicers.
Well, so if you're asking a question in the chat, I will also unmute your mic. So if you have any follow-up, you can respond by audio as well.
Even better, even better. And Cody Cox, do you plan on selling mortgages? No, we don't. We're not going to sell. We were an active seller to smaller investors in the past, and it's just a very big distraction. It's very hard to justify the enormous amount of effort to sell a few loans to private investors. So we won't be doing that. We will keep them on our balance sheet. We may do larger sales to institutional investors, maybe once a quarter, but we won't be selling one-off loans. Thanks for the question, Cody. I know you bought loans from us in the past, so sorry to tell you that. If a workout is not successful, are you foreclosing or selling it off? What are you investing in single-family homes? Okay, so about 60% of the loans we buy, so start at the beginning, we try to only buy occupied homes. We don't want single-family homes around the country that we need to rehab and sell. We're not in the fix and flip business like you see on the TV shows. We want to buy a house where there's a borrower in the home and we want to work out a deal with them. So we want to be finance people rather than real estate people. However, sometimes the people in the home will say, I'm not paying, never, no matter what you do. So in those cases, we foreclose. And what that means is it's basically a lawsuit. Our mortgage is secured on the real estate. We go to court, we show to the judge, if it's a judicial foreclosure, that the guy is not paid, and we need to sell the house to satisfy the debt. Typically what happens though is, close to the sale date, we'll work out a deal with the borrower that the borrower will sell it and we will give them some cash. It's called cash for keys, or we'll take a deed in lieu of foreclosure. So they will just abandon the property to us and we will sell it with the local broker. We've taken about 60 houses out of the last 1,600. I'm within 1% of being correct. We've taken 60 houses out of the last 1,600. So it rarely ends up with us taking back the property. It usually ends up with some sort of consensual outcome. Thanks, Cody.
Do you feel like having that chicken?
Sure.
I'll give you some money. Can you get me one too?
Yeah.
Look, I'm writing down all the people who are here.
Hey, Albert, would you mind muting?
Yeah, apologies, I couldn't find
That's okay.
the right one. But yes, again, everybody, if you want to follow up on your questions via audio, I will unmute, and you need to unmute on your side as well. But we will get the right participants to be unmuted, just because there seems to be a lot of background noise as well.
What about taxes? Yeah, so in some cases where the borrower is, so the question was, what about real estate taxes? So we're in a case where the borrower is not paying their mortgage, often they're not paying their real estate taxes either. So part of the technology system that we've built out, it draws from the county to ensure that not only is the borrower paying the taxes, but also is the home insured. Is the borrower in bankruptcy? Because if the borrower is in bankruptcy, we're not allowed to talk to them. We can only go through the bankruptcy courts. We've also got to check in many jurisdictions. I don't mean to pick on Cook County, but we've had a lot of experience in Chicago. There's a lot of municipal rules there which carry heavy fines if you don't adhere to them. So if your grass in your yard is more than 6 inches high, you'll be fined, and you'll be fined, I think it's $250 per day. And every day they find your grass is too tall, they fine you $250. So you can imagine how we felt when we first found out about that, because the first time you find out is often when you get the first bill. However, there is a way to negotiate because it's Cook County. So that's just one jurisdiction where we need to stay on top of what's going on in every part of in every county, and ensure that we are, either us or our vendors, are managing the properties in a way that is in compliance. And we aggregate all of that data and use that to make our decisions. So in some cases, we will need to advance the property taxes for the borrower. We add those to the loan and we can recoup them at the end, whether it's in a settlement or in a foreclosure. I think that's all the questions.
Yep, I think that's all I've seen on the screen. Yeah.
So I'll leave it there. That's good, because I have a hard stop at 2, so I might even get a sandwich today, which would be good. In short, we're continuing to accumulate cash because I think it's better to pay interest on cash you're not using than go out and chase deals where you might find that you could buy that same deal in 3 months that is at a lower price. Funnily enough, we've been in the situation where we've had loans, and for whatever reason, the value of the property that against which the loan is secured has gone down. And over time, those things tend to rectify themselves. If your diligence is good and you've bought good property that's occupied by somebody, over time, those prices tend to rise. And the mortgage business is a 30-year business. This is not a buy it on Monday and sell it on Tuesday type of business. So you need to wait it out. So I think on balance, it's the right thing to do. We'll continue to chase deals. We'll chase smaller ones, and we'll work with mostly with sellers that we've worked with before, so that we can allocate capital in a conservative manner and make sure that we're not going to try and catch the bottom, but make sure that we're not overpaying for things. And over the next 2 quarters or 3 quarters, I think things will start to take shape, and we'll see business ticking up. Interestingly, on the loans that we've owned for 3 or 4 years, our prepayment, which is people paying off ahead of schedule, has been very high, and I think that's driven by a couple of factors. Firstly, a lot of the loans we own, the borrowers have very high FICOs. Our average FICO is about 660, which in the distressed debt business is very high. And we've noticed those at 700 and above are refinancing at a rapid rate. And so that's kind of a bounty. You expect to be collecting $400 or $500 a month for 30 years, and you might get 250,000 or 300,000 come in. In fact, last week we got $657,000 from a single borrower, and you just never know. So we'll just continue doing what we're doing, which is making sure we don't take on too much risk and focusing on extracting the best deal from every property that the borrower can afford, that keeps them in their home and keeps them paying, and generates return for the fund. So that's it for those of you who are prospective employers. Please do make sure to investors. Please do make sure to read the SEC filing. It's on the SEC website. It's on our website, and feel free to send me a mail. I'll happily send you a copy. And I'll do another webinar next month. We'll cover what's happening then. And people have asked to focus in more on the deals. So happy to share some deals on how the workouts have actually gone. So I'll leave it there for right now, and I look forward to talking to you on my Thursday updates, and also on LinkedIn. So thanks very much for your time, and I will say goodbye. Thanks. Bye.